Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. Back with another update today on something that is a little different to what we normally cover here on the channel. Thank you to those that have already liked and subscribed. If you haven't, I would love it if you could do that. Please do me a favor. It helps me to grow the channel. And today we're talking about something that doesn't exactly fit the formula. So we better have a damn good reason as to why we're venturing into this particular play. Okay. Now, normally when we look at assets to add to the portfolio, we want assets with low debt. The company we're talking about that today does not have low debt. They have a lot of debt. Margin of safety, they do have a margin of safety, which I'll explain in a moment. Sales growth, they are set to grow like a rocket ship. They have strong enough margins in terms of a free cash flow margin. Free cash flow growth, they will be able to do, but it's not so much a consideration of ours because we are actually not looking to hold this stock for a particularly long period of time. And they don't have a history of share buybacks. Okay, so let's get into it and see. First of all, what is the purpose of this particular stock? Well, do you remember at the start of the channel, start of the year, when I put forth some of the fund, how the fund would be constructed? There was this convexity bias where you would have a small positions in the fund that had a high reward to limited risk ratio, but that doesn't mean that they're necessarily low risk, and it doesn't necessarily mean that they are high quality businesses. Okay, well, this would be a stock that would fall into that category, and I'm going to explain why. This is a business that rents out or leases out offshore rigs. Okay, it's a Transocean, a company that leases out a whole heap of equipment to allow other oil companies to drill oil out of the deep sea environment. Okay, so they have a fleet of rigs that they lease out, and so obviously they're tied to the performance of the underlying commodity, which is oil. Let's have a look at some quick facts of the business, and they are terrible. This is a terrible business, capital intensive business, burns through cash like it's going out of fashion, but once every 10 years or so, you get a chance for a company like this that is basically priced for bankruptcy, that acts as a massive call option if you're right about the underlying thesis of the commodity that they sell or that they are tied to. So they've got negative CAGRs for revenue and the EBITDA. Their market cap's 2.2 billion, so they're a decent sized company. They're not a small cap. Enterprise value 8.8 billion. The price at the moment, time of filming, is $3.42 US. 651 million shares outstanding. Terrible return on capital, less than inflation. Their net debt to EBITDA is high, 5.88. Remember, 3 is normally our maximum if we're looking to hold a stock long term. That is slightly artificial because their EBITDA has shrunk due to COVID last year. Okay, so it does look a little worse than what it actually is, and so I've put in here the EBITDA to interest or the debt service covering ratio. Okay, which means every month or every term period, how much interest do they have to pay versus their EBITDA, so what they're earning before the interest and depreciation, amortization payments. Okay, so they can service their debt. They're priced in as a bankruptcy risk, but I think that there's a lower probability that they will go bankrupt, and I will show you that even if they do go bankrupt, we might get a windfall in profit. So this metric here, which I don't normally put in this chart or this slide, tangible book value to share. So what that means is on your balance sheet as a company, you've got assets, you've got liabilities. Okay, now your book value in theory will be assets minus liability, and that will give you a number. Okay, for a company like this, it is worth looking at because they're a hard asset company. They've got lots of rigs, they've got lots of equipment, tangible things that have a resale value. So the company goes under and they have to liquidate all their machinery and their assets. What is the theoretical value of that number? So they've gone through and they've calculated the market value of all the rigs that they have and all the equipment and so on and so forth, and it works out to be we'll round it up and say $18 per share. Okay, which is obviously a huge discrepancy between the current share price and what the calculated value of the book value per share is. Okay, so if a company goes into bankruptcy, we as the shareholders won't be first in line to make a claim. Okay, it will be the bond holders essentially. Okay, so the debt holders of the company, they get first claim on recouping their investments, and then whatever's left over that, whatever can be sold and recouped through the bankruptcy court, that's what's available for equity holders, which would be us in this case. Okay, obviously the company could restructure, and that's something that happens quite a bit in these cyclical, capital intensive businesses. So this is over the last year. Okay, so the company got smashed, and since then has been on a massive recovery. So if you manage to somehow fluke the lows in the midst of COVID, where the oil's futures were trading negative, and that would take a lot of conviction. Congratulations, because you've got a 284% upside already. If we take a slightly bigger picture view, over the last 5 years, get my head out of the way there, this is the price action of the stock. So you see strong oil environment, they're able to lease out most, if not all, of their fleet, and they are able to command much higher day rates that they charge. Okay, then oil goes negative. This is not a good thing if you're an offshore driller. And so as you see there in that trough in the midst of COVID, the company was basically looking like it was going to have to restructure as a bankruptcy risk, along with, I think, Noble Corp and Valaris and some of the others in that industry. And so you could have scooped them up for, I think, about 80 cents was the low that they got to there. Very interesting. They made a bit of a rebound. Oil futures are back on into positive territory, and we have much more of a market for offshore rigs. Okay, so it's an interesting situation where every now and then, when a company's set for bankruptcy, it either goes bankrupt, restructures, and then refloats on the public markets. That's a time where you can make a ton of money, but you've got to get it right, or you may be in risk of taking a big bath. And so we're looking at this as a high convexity bias, because we have what we believe is a limited risk. We know what the risk is. If we said today, what's the chances of the company's going bankrupt? That's how we're going to assess it. Okay, I think it's a low probability, much lower than what people were pricing in. I'm not saying it can't happen; it absolutely could. And if something happens in the economy to mess up the oil price, and that would be disastrous, obviously, for any oil-related business. The quick ratio, okay, so current assets minus liabilities for 12 months is greater than 1. Okay, so they can meet their liabilities over the next year. So if they can see out this next year and oil prices go where I think they need to be, they're currently well above 70 and stable, this company can absolutely continue to operate, keep its head above water, so to speak. Tangible book value, if the company goes bankrupt, this is what they're saying, or what analysts are saying each share would be worth in theory. Now, that has been re-rated down to that number, okay? So it's fairly conservative, but think about selling something on the secondhand market. You never get exactly what you, or even anywhere near what you expect. So I have said, what if I put a massive margin of safety here and saying that only Transocean can only get 30 cents on the dollar worth of their assets that they sell. Okay, so massive discount. That leaves us somewhere around $6, okay, which is obviously still basically almost a double from where we are in terms of the share price. So we're taking our margin of safety by saying we're going to exclude what I actually believe is going to happen with oil prices and the cash flows that are going to come into the company, which will increase its value. We're going to say, what if the worst happens? This thing goes bankrupt, belly up. You pay out the debt holders or the creditors, and you say whatever's left, we discount that at fire sale. We get only 30 cents on the dollar, and although we'll have to wait a while for these proceedings to play out, we're looking at $6 as the value of the parts, basically. And our call option on the upside, what if things really do go well? How high can this company go? So let's have a look. I think that oil's going to triple digits. I think we'll easily see $100 per barrel by 2022, if not by the end of this year, 2021. Goldman Sachs, this morning, I believe it was, I read a news article that they've upgraded their target price for oil from $80 to $90 US per barrel. The banning of fracking and the pummeling that shale has had in the US used to be a net exporter for the first time in many, many years of oil. The Biden administration has has taken care of that self-sufficiency. And so that means that companies have to start to move offshore. Now, offshore has, I believe it's only 25% of the emissions of the oil produced on land. So it's much lower emission. So it keeps the green crowd relatively happy. And so relatively happy, less unhappy, let's say. And so what you're going to find is these major producers are going to start to say, well, we can't frack or do what we used to do on federal land. So they're going to start to move offshore. Transocean's competitors have basically gone bankrupt. So Valaris and Noble Corp that I mentioned, they're in a restructure at the moment. They did not survive. And so Transocean's got the fleet. They've got the rigs there to rent out. So on a company call, management is alluding to the fact that they could reach their day rates from $225,000, which is their lowest rate under contract today. Those contracts will have to be renewed. They're not going to roll them over. They're going to be renewed by the end of the year. And so they're anticipating even up to $400,000 US per day, the cost of renting a rig. So that's about a third more to the day rate revenues than where they're currently at the moment. So another interesting piece is the insider buying. Okay, so in June 2021, we had 14 directors that bought more than 1 million shares each. Okay, so that's 1 million, 1 million, 1 million for 14 different directors, to be clear. And the lowest price that they paid was $3.93, which is above where the shares are today. Now, that's not the be-all and end-all, but if you read a lot of Peter Lynch's work, he'll say that directors can or insiders can sell for any number of reasons, but they only buy for one reason. Okay, so the management is certainly confident that they're in a good position to have the liquidity to see out the rest of the tough times for this year, and they'll be able to cash, or they're expecting at least to cash out in the stronger oil prices for 2022. Okay, so that's a very, very interesting. It's not something you can hang your hat on, but it is something you definitely want to know. Okay, so what if different ways of projecting future scenarios? So what if the revenue did increase to that $400,000 a day rate? I've taken the 2020 revenues, increased them by a third, okay, and used the free cash flow margin that they currently have. So I assume no increase in efficiency between now and then, even though they have paid down a lot of debt. Free cash flow per share would come in at this number here. So we'd be looking at, all other things being equal, and if this plays out, of course, $1.83 per share. What multiple do we apply? Magic question. Well, I've skipped ahead. 4.5 multiple would give us $8.25, which would be a very, very healthy return. If we got all the way up to 11, which has happened to the company in the past, I mean, that's certainly very bullish, but in an environment where you've got a very inflation-sensitive environment and people can't get any yield, they're not getting any return on their investment in other assets, maybe it will bid up to 11 times. I don't know. So what we've done is taken the average, and the average for that is a 4-bagger. Okay, if you're not familiar with that parlance, that means you got 4 times your investment. Okay, at a target price of $14.20, which, as the contracts start to come up for renewal, this could happen by the end of 2022. 2023 at the latest, and that would be when we would completely exit the position. We would not keep much at all in this particular position. We're looking at this as a call option to provide some outsized returns. So full credit, this comes from I think Beach Capital on Twitter. smart guy. I was reading through an article that he has put out. This just gives you an idea of the capital structure. Okay, I'm not going to go through the ins and outs of it. I probably lost you already, but up here is what you want to know. So we've got these guys at the top. They get their priority on the assets should the company go bankrupt. So debt holders or creditors have to be paid out before equity holders. Okay, so their assets can pay these guys out and then some, and leave over some value for us as the equity holders. Okay, these will be the key dates to keep an eye on. Okay, so March, I believe it's 23rd of March 2022, they've got to pay about $83 million to their creditors, and so they'll have to obviously keep cash on hand for that. They've got plenty of cash, as you can see here. Okay, so total cash 1.45 billion, 388 of that due to the covenants in their financing, I believe, has to be kept as a reserve to service debt. And then they've got about $1 billion there to play with in terms of paying people out and keeping them happy. If we look at their fleets, okay, they have got 22 under contract, okay, 2 left. They've got 2 left, okay. You've got basically no one left in the Gulf of Mexico with rigs pumping out oil. We've got almost all the competitors for Transocean that have gone bankrupt. Okay, they're out of action. They're done. They're cooked. And you've got these major producers that need to stay off federal land in the US, but still supply the increasing demand. If 2022, 2023 airplanes are back online, holy moly, think about what that does to the demand for oil. And the replacement rate for oil has been declining. Okay, we've really been burning through the supply, and I think a lot of people are going to get caught out in terms of when demand eventually comes back online. If life returns to some semblance of normality after COVID, then we're going to get a rude awakening in terms of the oil price. Anyway, so this is what they got to play with. Okay, and I would suggest that they might look at buying or leasing out and then subleasing one of their competitors' rigs. It could happen if they can get their fleet up to up to 50 rigs perhaps from the 39 and have them fully utilized. This company is a cash machine. Okay, absolute cash machine. So if there's a good spot. Okay, if I do some back of the envelope calculations here and put in the daily inputs, okay, and this is on a per day basis, and I say, what's the scenario if their rent, okay, the rent that they collect is this number here, okay? So they're around about here now. They've renegotiated a lot of contracts in the $325,000 per day rate. And then I've put in these assumptions. So the OPEX will be the same. The cash flow will be their rate, the daily rate minus their daily OPEX, okay? And then you've got, that's a cash flow before, I'm not including taxes and all the rest of it. The number of rigs, okay? So if they can start to increase the number of rigs they own and the number that they rent out, obviously that's going to massively increase. The number of days that they would lease them for, they would be in the contract, okay? So they wouldn't decrease. And the EBITDA would be this. And what multiple do we apply? Okay, so I've said a multiple of 7 seems fair. You can obviously change that if you wish. Okay, you can move it up, move it down. This would be the associated enterprise value. You got to add back the debt, okay, and then or minus the debt away and add back the cash if you want to look at the equity value, and then divide that by the shares on issue, okay, and then we end up with our implied share price. Okay, so a few things to note. Where I've got here, I've got 651 million shares. Other analysts have used 617 million. Okay, so just a word to the wise. I've just said, look, what if the share count doesn't change? They don't dilute, but they also don't contract, and so I'm going to stick with that. It's last year's numbers because I went off the financial year data in ticker, but those that have looked at the quarter 1, the quarter 21, I see a few people using 617. Anyway, obviously you can change that with a similar table. It's a sensitivity table. That's the beauty of it. And as we start to increase their day rate, look what happens to that share price, okay? And then our associated return if things play out and we get in at the current share price, okay? So if we could get a $15 price target on Transocean, that's a massive, massive win. That's a 5-bagger or near enough, and that can happen quite quickly. And even if we only allocate a very small percentage of the funds, I think it's got a great opportunity, given that we've already said if the company goes bankrupt, that's the worst case scenario. We might get a double, all right? And if things go even better, we might get 5x or more, who knows, okay? So it's worth allocating a small amount of the funds because the risk-reward ratio is definitely there, okay? So the verdict is it's a buy. I'm looking to build up about 2.5% of the assets under management. That's a bit more than I'd normally do for a play like this, but our other options, all the major producers in oil are off their heads in terms of what they're doing. BP's flogging off some of their assets for less than liquidation value. They've got all these ESG guys on their boards. They're basically sabotaging the companies is what they're doing, which I don't know if shareholder sabotage is a corporate crime, but it probably should be, because I wouldn't be very happy if I were a shareholder of some of the majors. So we've moved out, exited the position in ExxonMobil. We've made a small profit, and I think that it's justifiable for me now as the fund manager to allocate a few more funds to a company like Transocean, given the opportunity that's there. I think it's a once-in-a-decade opportunity if it pans out. Thanks for watching. I'm going to leave it there, a bit longer today, but because it's not normally it doesn't follow the normal investment formula that we use, I needed to give it a bit more of an explanation, or so I felt. If you haven't already checked out the portfolio, click on the link. That'll take you to eToro, and you can add it to your watch list. If you've got some funds ready, by all means, feel free to copy. I would consider that an honor to manage your funds. Thank you if you've liked and subscribed. If you haven't, I'd appreciate you doing that. And as always, do your own due diligence, especially with a speculative play, and that's exactly what this is. It's not a certainty by any means. Make sure you do your own due diligence. You're responsible for your own decisions. Thank you for watching. I wish you all the best, and I'll be back with another idea in another video.